Try to picture this. It is the morning of December 10th, 1930, and thousands of people are pressing toward a bank branch on Southern Boulevard in the Bronx. Some arrived because a neighbor told them something was wrong. Others saw the line from the street and decided that the line itself was proof enough. Police are trying to keep the crowd orderly. Bank employees are paying out cash as quickly as they can. Armored cars bring in more currency. Every person who reaches the teller window leaves with exactly what everyone still waiting wants. Physical money in hand, no longer trapped behind a marble counter and a locked vault door. The bank is called the Bank of United States. Despite the name, it is not part of the federal government. It has no special national guarantee. It is a private New York bank that has grown rapidly through mergers and branches, serving hundreds of thousands of depositors, many of them immigrants and working families who trusted the grand name on the building. By midday, the crowd has grown into the tens of thousands. Millions of dollars are withdrawn. The bank meets the demands that day, but confidence is already breaking faster than cash can be delivered. The following morning, its directors surrender the institution to New York banking authorities. The doors close. More than 400,000 depositors suddenly discover that the numbers printed in their passbooks are no longer spendable money. They are claims against a failed institution. That is the part of banking we rarely think about now. A bank balance feels like money because you can use it like money. You write a check, swipe a card, send a transfer, or walk to an automated teller and turn the number on a screen into cash. But legally and economically, a deposit is also a promise. The bank owes you that money. Before federal deposit insurance, the value of that promise depended on the condition of the bank, the quality of its loans, the honesty of its managers, the strength of the local economy, the behavior of other depositors, and sometimes a rumor moving through town faster than anyone could verify it. So, what happened when your bank failed before deposit insurance? Did you lose everything? Did you get some of it back? How long did you wait? And why would anyone put their life savings into a system where the money could disappear behind a closed door overnight? To answer that, we need to understand what a bank actually did with your deposit. Imagine you walked into a small American bank in the early 20th century and deposited $100. The bank did not place your exact bills in an envelope with your name on it and leave them untouched until you returned. If banks operated that way, they would be little more than guarded storage rooms, and they would have to charge depositors heavily just to keep the doors open. Instead, the bank kept only part of its deposits available in cash or other liquid reserves. The rest was lent out. Your $100 might help finance a farmer's seed, a merchant's inventory, a family's mortgage, or a local factory's payroll. The borrower spent that money, and much of it eventually returned to the banking system as someone else's deposit. This is the basic structure often described as fractional reserve banking. The word fractional does not mean the bank was secretly stealing part of your account. It means the bank kept only a fraction of total deposits and immediately available reserves because under normal conditions, only a fraction of depositors asked for their cash on the same day. That arrangement made economic growth possible. Savings that would otherwise sit idle could be transformed into farms, stores, homes, machinery, and wages. But it also created a permanent vulnerability. Depositors were promised access to their money on demand, while much of that money had been converted into loans that might not be repaid for months or years. A bank could be perfectly healthy in the long run and still be unable to produce enough cash in the next hour if everyone arrived at once. This is the difference between solvency and liquidity. A solvent bank owns assets that are ultimately worth more than what it owes. A liquid bank has enough cash or assets that can quickly be turned into cash to meet immediate withdrawals. A bank can be solvent, but temporarily illiquid. It can also look liquid, right up until the moment people discover that its loans are bad and that uncertainty was the fuel of the bank run. If you withdrew early and the rumor was false, you lost only time. If you waited and it was true, the people ahead of you took the cash. Maybe it was false. Maybe the bank had suffered a manageable loss that would become fatal only if everyone panicked. Your decision was still brutally simple. If you withdrew early and the rumor proved false, you'd suffered only inconvenience. If you waited and the rumor proved true, the people ahead of you might take the remaining cash and leave you with a frozen claim in a receivership. The rational choice for each individual depositor could create disaster for the group. Banks also suspended payments. That phrase could sound almost polite, but to a depositor, it meant the bank had stopped giving people their own money. Sometimes a suspension was temporary and saved a fundamentally sound institution from being destroyed by panic. In some eras, banks across an entire city or region suspended cash payments together, hoping that if no one bank was singled out, the public would wait for the emergency to pass. But a suspension could also conceal insolvency. The closed window gave officials time to inspect the books and determine whether the bank needed a few days of breathing room or whether the money was genuinely gone. The answer often depended on where the bank's assets were located. America's banking system was built as a network. Small country banks did not keep every reserve dollar in their own vaults. They placed balances with larger banks in regional cities. Those banks, in turn, kept money with major correspondent banks in places like Chicago and New York. The system allowed funds from thousands of communities to move through the national economy. It also created a chain of dependence. A rural bank might appear completely local. Its president lived in town. Its borrowers were farmers and shopkeepers. Its name was painted on a brick building beside the courthouse. But part of its liquidity might depend on a correspondent bank hundreds of miles away. If that correspondent failed, froze withdrawals, or suffered its own run, the country bank could lose access to reserves precisely when nervous customers wanted cash. Trouble traveled through relationships that ordinary depositors could not see. For a family, the closing of a bank was not an abstract financial event. It could mean that the money saved for winter coal, rent, tuition, a wedding, or a medical operation was locked up. The account still existed on paper, but the family could not spend it. A receiver would take control of the failed bank, collect whatever loans could be collected, sell property, pursue dishonest officers if necessary, and distribute the proceeds to creditors. Depositors might eventually receive part of their money in a series of dividends, but eventually could mean months or years. For merchants, the consequences multiplied. A store owner might have deposits frozen on Monday and invoices due on Tuesday. Checks written before the closure could bounce, even if the merchant believed the account contained enough money. Suppliers might stop extending credit. Employees might be sent home without wages. Customers, frightened by the same crisis, would cut spending and hoard currency. The failure of a bank reduced not only the wealth of its depositors, but the circulation of money through the whole community. Farm towns were especially vulnerable because local banks were often tied to the same crops, the same land values, and the same weather. A bank whose borrowers all depended on wheat or cotton was not diversified in any meaningful sense. If prices collapsed or drought ruined the harvest, many loans weakened at once. The bank could not protect itself by relying on a different industry in a different region because laws and custom had produced thousands of small, geographically restricted institutions. This is an important distinction. Not every failed bank was run by criminals. Some were. The Bank of the United States, the institution whose branches were surrounded in December of 1930, was later associated with fraud, insider abuse, and reckless self-dealing. But many bank failures came from ordinary banking risks amplified by a fragile structure. A careful banker could lend against land that appeared valuable only to watch farm prices collapse. A respected local institution could be overwhelmed when borrowers defaulted together. A solvent bank could be damaged by a run. A weak bank could be exposed by one. And a dishonest bank could hide behind the public's inability to tell the difference until it was too late. This vulnerability was not new in 1930. American banking history had been marked by repeated panics long before the Great Depression. In the 19th century, major crises struck in 1837, 1857, 1873, and 1893. The details: the Federal Reserve was supposed to make the banking system more stable, an elastic currency, emergency liquidity, but it did not ensure deposits, and thousands of state banks were not members. Demanded cash. Banks called loans and sold assets. Credit contracted. Businesses failed. Unemployment rose. And the effort of each institution to protect itself made the overall collapse worse. The Federal Reserve was supposed to make the banking system more stable by providing an elastic currency and emergency liquidity, but it did not ensure deposits. It could lend to eligible banks under certain conditions, yet many thousands of state banks were not members of the Federal Reserve System. The new central bank also did not promise that every depositor in a failed institution would be repaid. A lender of last resort could help a solvent bank survive a temporary cash shortage. It could not make worthless loans valuable, replace missing assets, or guarantee every bank account in America. The idea of deposit insurance had been debated for decades. Starting in the late 19th century, proposal after proposal reached Congress. Supporters argued that ordinary depositors could not examine bank balance sheets, evaluate loan portfolios, or monitor hidden relationships among directors and borrowers. They believed that deposits were so important to daily commerce that the public needed protection. Opponents answered that insurance would reward bad bankers, punish good ones, and encourage depositors to stop caring where they placed their money. The debate was not theoretical because several states tried their own guarantee systems. Participating banks paid assessments into a common fund that was supposed to reimburse eligible depositors when a member bank failed. Oklahoma moved first after becoming a state. Its deposit guarantee law was approved in December of 1907 and became effective early the following year. Other states, including Kansas, Texas, Nebraska, Mississippi, South Dakota, Washington, and North Dakota, created systems of their own during the years that followed. The assessments were also politically difficult. Sound banks resented being charged for the losses of reckless competitors. If the fee was kept low, the fund remained too small. If officials raised the fee during a crisis, surviving banks had to pay more at the exact moment they were weakest. Some systems allowed banks to enter without strong enough supervision. Others did not build reserves quickly enough. And once depositors believed their money was guaranteed, they had less reason to distinguish between a conservative bank and one offering unusually high interest while taking unusual risks. Oklahoma's system eventually became unable to meet its obligations. By the early 1920s, liabilities outran the guarantee fund's resources. Payments were suspended, and the law was later repealed. Other state systems also failed or disappeared. To many bankers, these experiments proved that deposit insurance was not protection at all. It was a machine that allowed weak banks to borrow the reputation of strong ones until the common fund collapsed. Supporters drew a different lesson. They argued that the state systems had been too small, too regionally concentrated, too lightly supervised, and too dependent on assessments that arrived after losses had already occurred. A national system could spread risk across industries and states. It could examine banks before admitting them. It could close unsafe institutions, build a larger fund, and use federal authority to collect assessments. The failure of state guarantees, in this view, did not prove insurance was impossible. It proved that badly designed insurance was dangerous. Then the Great Depression turned a long-running policy argument into an emergency. Bank failures had never disappeared during the prosperous 1920s. Rural institutions were already under pressure as agricultural prices weakened after the First World War. But after the economy entered depression, failures accelerated. Borrowers lost income, property values fell, loans went bad, depositors withdrew cash. Banks sold assets into declining markets, pushing prices down further and weakening other banks that held similar assets. In 1930 alone, more than 1,000 banks suspended operations. The collapse of large banking networks in the South and Midwest spread fear across regions. Then came the Bank of the United States in New York. Its failure was enormous, public, and psychologically devastating. The name sounded official, even though it was not. If a bank that large in the nation's financial capital, with hundreds of thousands of customers, could close, then what exactly was safe? The panic did not move in one clean national wave. It struck in clusters. One region would calm while another deteriorated, but each failure taught depositors the same lesson. Waiting could be punished. People converted deposits into currency. Banks responded by holding more cash and making fewer loans. That protected individual institutions, but starved the economy of credit. Businesses cut production. Farmers could not finance crops. Construction stopped. Payrolls shrank. The banking crisis and the economic depression fed each other. By early 1933, the crisis had reached the point where state governments began declaring banking holidays, temporarily closing banks to stop withdrawals. The holidays spread from state to state. On March 6th, only days after taking office, President Franklin Roosevelt declared a national bank holiday. Banking transactions were suspended across the country while examiners determined which institutions were healthy enough to reopen. Roosevelt addressed the nation in his first fireside chat and explained banking in unusually direct language. He told listeners that banks did not keep all deposited money in vaults, but invested much of it in loans and other assets. The problem, he said, was that when everyone demanded cash at once, even good assets could not be converted quickly without heavy losses. His purpose was to persuade Americans that inspected banks could reopen safely and that redepositing currency was an act of rational confidence, not blind faith. The Emergency Banking Act gave the government power to examine, reorganize, support, and reopen banks. When institutions began opening again, deposits flowed back. The immediate panic eased, but the central question remained unresolved. What would happen the next time a bank failed? Would depositors again be forced to race one another to the teller window? This was where the political fight over federal deposit insurance became decisive. Representative Henry Stegall of Alabama strongly supported a guarantee for bank deposits. Senator Carter Glass of Virginia, one of the principal architects of the Federal Reserve System, focused heavily on separating commercial banking from securities speculation and was wary of broad insurance. Many large bankers opposed the idea. They argued that well-managed institutions would be forced to subsidize poorly managed ones. They remembered the failed state funds. They feared that a federal guarantee would weaken discipline and create a permanent political obligation. Roosevelt himself was not initially enthusiastic. He worried that guaranteeing bank deposits could encourage irresponsible banking and place the government behind losses it could not control. His administration wanted reform, supervision, and the reopening of sound banks. But deposit insurance carried risks that could not be dismissed simply because the public wanted protection. The public did want it. After years of frozen accounts, lost savings, and closed banks, the argument that depositors should personally monitor bank management sounded detached from reality. A factory worker could evaluate the reputation of the bank president, perhaps. A farmer could know who sat on the board, but neither could inspect every loan, trace correspondent balances, calculate capital adequacy, or detect insider transactions hidden behind affiliates. Ordinary people had been told to save responsibly, and then many had watched responsible savings vanish. Congress pushed ahead. The Banking Act of 1933, signed on June 16th, created the Federal Deposit Insurance Corporation. Deposit insurance was one part of a much larger law that also reshaped the relationship between commercial and investment banking and strengthened federal oversight. The insurance system did not begin paying protection immediately. The temporary fund took effect on January 1st, 1934. At the beginning, the basic insurance limit was $2,500 per depositor at an insured bank. That amount covered the full balances of the overwhelming majority of ordinary depositors at the time. The limit was increased to $5,000 effective in July of that same year. The promise was deliberately limited. It did not guarantee every financial asset. It did not protect shares of bank stock, bonds, or investments merely sold through a bank. It did not make losses above the insurance ceiling disappear. It did not cover money placed in an institution that was not admitted to the system. It protected qualifying deposits up to the legal limit in participating insured banks. National banks were required to participate, while eligible state banks could join under the rules then in force. Banks had to be examined. Insurance was not meant to place a federal seal on every institution, regardless of condition. The system combined a guarantee for depositors with supervision, assessments, and the power to deal with failed banks. Participating banks paid into the fund. The government provided initial capital support, but the long-term structure depended on charges levied on the banking industry rather than a simple promise that every loss would be paid directly from ordinary tax revenue. The psychological change was immediate. Before insurance, a rumor forced a depositor to ask, "Will this bank survive until I get my money out?" After insurance, a small depositor at an insured bank could ask a different question. Even if the bank fails, is my balance within the protected limit? That difference attacked the logic of the run. If leaving your money in place no longer threatened total loss, there was less reason to stand in line at dawn. The first insured bank failure came only months after coverage began. The Fond du Lac State Bank in East Peoria, Illinois, closed in May of 1934. In July, the new corporation began paying insured depositors. Lydia Lobsiger received $1,250, restoring her life savings. The amount was modest compared with the giant failures of the Depression, but the meaning was enormous. For the first time under the national system, the federal deposit guarantee became something more than legislation and promises. A depositor in a failed bank received insured money back because the insurance existed, but the same protection that stopped runs also changed incentives. Economists later gave this problem a name: moral hazard. The phrase does not mean bankers are automatically immoral. It describes what happens when protection from loss changes behavior. A driver with insurance may take risks differently from a driver who must personally pay every repair bill. A bank whose depositors are protected can raise money more easily than a bank whose customers fear losing everything. That stability is the entire purpose of insurance, but it can also weaken one form of market discipline. The answer was not to pretend the trade-off did not exist. It was to pair insurance with regulation, examinations, capital requirements, restrictions on activities, assessments, and the authority to close failing banks. The depositor no longer had to serve as the primary bank examiner. Public supervisors and the insurance corporation took on more of that responsibility because the public fund now had money at risk. Deposit insurance also did not prevent banks from failing. Poor loans still existed, fraud still existed, recession still damaged borrowers, interest rates and asset prices still changed. Bank owners and investors could still lose their capital. Managers could lose their institutions and careers. Depositors with balances above the legal limit could still face losses, especially in eras when authorities did not protect uninsured funds through some other resolution. Insurance changed who absorbed certain losses and how quickly protected depositors regained access. It did not repeal financial risk. And yet, for the ordinary household, the change was profound. Before 1934, placing money in a bank meant accepting the credit risk of that bank, whether the depositor understood it or not. The passbook was evidence of a private debt. If the bank failed, the depositor joined a line of claimants and waited for liquidation. After federal insurance began, a covered deposit at an insured bank was still legally a liability of the bank, but it was backed up to the statutory limit by a national system designed to make that promise credible even after the institution itself disappeared. But the deepest change was psychological. Before deposit insurance, the banking system demanded confidence while giving ordinary people limited reasons to feel secure. Everyone was expected to behave calmly, even though being the last calm person in line could destroy a lifetime of savings. Federal insurance changed that calculation. It did not ask depositors to ignore danger. It removed the need for millions of small depositors to respond to danger by creating a panic. That was the old system's cruelest feature. It turned trust into a race. The people who moved first might survive. The people who believed the reassuring notice on the door might lose access to everything. And even when a bank eventually repaid much of what it owed, the delay itself could ruin lives. A savings account that returned years later could not restore the business that missed payroll, the farm sold under pressure, or the medical treatment postponed when the cash was needed. Federal deposit insurance did not make banking innocent, simple, or perfectly safe. It did something narrower and more important. It separated the fate of the small depositor from the immediate fate of the bank, up to a defined limit and under defined rules. It told ordinary customers, "Thanks for watching. We go deep into the systems that feel permanent, only because most of us never saw the world before them. Balance was never just a pile of money waiting in a vault. It was a promise supported by loans, reserves, institutions, law, and confidence. Before 1934, that promise could collapse into a claim that took years to collect. After deposit insurance, the promise became stronger, not because banks stopped failing, but because one bank's failure no longer had to mean the destruction of every covered depositor standing behind its doors. So, the next time you look at a bank balance and treat it as money, remember what that confidence is built on. It is built on centuries of failures, panics, frozen payrolls, ruined farms, political arguments, failed state experiments, and millions of people who once learned that a passbook was not the same thing as cash. Deposit insurance did not create trust out of nothing. It created a structure strong enough that ordinary people no longer had to destroy the banking system in order to protect themselves from it. If this story changed the way you think about the money sitting in a bank account, consider subscribing to the channel. We go deep into the systems that feel permanent, only because most of us never saw the world before they existed. Thanks for watching, and I will see you in the next one.